I'm Jacob Milliken, owner of 9M Investments, and today we're going to be talking about compound investing. Now, when we start talking about the power of compounding, at first it seems like a very simple concept. It's been around for a very long time. Sometimes I think it's good to revisit this concept to really kind of see how it works and why compounding can feel very slow up front, but then speed up as we accumulate assets. So, first off, what is the power of compounding? It's basically the ability for your money to grow on itself. And so for a lot of people, especially when they're starting out, those can be kind of the hardest time. So when you're first starting out, let's say you had a $50,000 portfolio, you added $10,000 contribution to that portfolio, you invested over 20% of that portfolio. That same $10,000 added to a $450,000 portfolio only increases it by about a little over 2%. So meanwhile, the 7% return on that 450,000 is over 31,000 in dollars terms. And so, all of a sudden the 7% where on a $50,000 portfolio is a couple $1,000, well, that same 7% obviously on a bigger amount is a much larger amount. And that's really where we start to see the power of that over time, especially if we are reinvesting those gains. And all of a sudden, it's not the $450,000 that we're building from, it's the 481,000. So again, that's why compounding seems to accelerate as we move along, because as those gains become larger, they just added to the pile. And if we start getting that, 7-10% range, those numbers just get larger every single year. Now, obviously, from a compounding standpoint, it takes patience. And starting out, if you're putting $50 in, $100 in, to a 401k, into a 529, into any of those things that we put in to kind of start off, it's going to seem like it's not moving very much. So we get that 10% gain, and it actually only goes up a few dollars. Versus as we get some assets, all of a sudden that's not $50, that's $500, or down the line that's not $500, that's $5,000. So but it does require patience. And so that's the hardest thing as you start to see this. One of the little tricks that I use to kind of think about, okay, what are these future gains look like, is using the rule of 72. And so, if we're going to average 10% closer to what the S&P, or if we're going to be more in a retirement focused portfolio that's closer to 7%, well, we can say, okay, based in 10 years on 7%, we're going to double your money in 10 years. If we're at 10%, we're going to double your money every 7 years and some change. And so that kind of gives you an idea of, okay, I know this is what it looks like today. We're getting started. I have patience, but using those Rule of 72 numbers can kind of give you a rough draft outlook of what does that look like. Obviously that doesn't include, any savings you do along the way. So, but it's a helpful guide to kind of give you an idea of what does that look like in the future if I continue to do those things that I'm doing now. So I hope this was helpful and a good reminder of the importance of compounding. If you have any questions, please reach out.